Hi everyone, Steve Nielsen here with a few words on super at the end of the financial year. Super funds over the past decade have returned strongly as a result of a growing world economy and mostly stable market conditions. This year would appear that it's not going to be much different. A survey conducted by Chant West found that growth funds in 2017 received a median return of 10.8%. However, they were greatly outperformed by the leading 5 industry super funds with an average return of 13.2%. What explains the higher returns of some funds, these industry funds? Some funds, mainly these industry funds, spend millions of dollars advertising with members' money the claim that their low fees and not-for-profit nature or structure are the reason for their superior returns. This may be true in part. However, they are still post significantly greater returns when benchmarked against other not-for-profit funds like the Future Fund, Australia's sovereign wealth fund led by former Treasurer Peter Costello, which generated a 12-month return of 8.1% for 2017. So, what's the real deal with this? What makes them perform so well? I believe the true reason for this outperformance is a direct result of some funds' severe, disproportionate allocation of clients' money to growth, for example, shares and property, and questionably labelling defensive assets, which are traditionally cash and term deposits, but has a wider explanation. Let's take the company at the top of the list, Host Plus Super, whose default balanced option, also detailed on the website, states a holding of 76% growth assets and 24% defensive assets. Firstly, the name balanced is, in my view, quite misleading. If you were told something was balanced, you'd feel that the holdings would be close to 50% growth and 50% defensive, right? Then if you delve into what Host Plus considered to be a defensive asset, the plot thickens. ASIC's Money Smart website defines defensive assets as cash or fixed interest investments that are generally low risk and less volatile than growth investments. Whereas growth investments are generally accepted to contain assets such as property and shares, which provide higher risk with the potential for higher returns. Host Plus lists the following assets as defensive, and this is the concern: 0% allocation to cash, 2% allocation to fixed interest, 9% allocation to property, 5% to infrastructure, and 6% to credit, and 2% to alternatives. This is very concerning. Firstly, there is 0 allocated to cash and only 2% to fixed interest, the traditional defensive assets. Also, the above allocations are not fixed. Host Plus has the ability to dial a defensive holding to as low as 0 if they see fit. An even bigger issue is that 14% allocation to property and infrastructure. Would you agree that property be classed as a defensive asset? Even Host Plus explain on their website that the property and infrastructure assets are considered to be medium to high risk. So really, these are growth assets. This brings the total growth asset in Host Plus Balanced Fund to close to 90%. Remember, this is their balanced fund. Having a greater exposure to growth assets, see riskier, in rising markets may equal superior returns and has. However, when the market does correct, and it will, having a greater exposure to growth assets could potentially lead to greater than market losses. There's a lot of concern around the disclosure here. Unlike public companies, super funds are not obliged by law to disclose detailed investment outcomes, senior executive remuneration, and they don't need to provide members with the full set of their audited accounts. Furthermore, super funds aren't required to disclose how they classify their investments, not even to APRA, the Australian Prudential Regulator Authority, or ASIC, the Australian Securities and Investments Committee. They also aren't required to share how each asset has performed or even what it is. There are also transparency concerns. The infrastructure and property holdings, which the likes of Host Plus define as defensive assets, are held in unlisted vehicles, which raise 2 concerns. Firstly, the value of these investments is the opinion of the fund manager in a lot of cases, and there is no way of knowing whether the value is credible given that there is no open market for the asset in a lot of cases. The investment is very illiquid for number 2, and the sale can be constrained by agreements with the co-investors. This goes against a critical characteristic of a defensive asset, which is the ability to sell in a deep and open market. The inherently risky nature of these investments is usually exposed during the end of a market cycle, and we're nearly there. For example, following the GFC in 2008, the real estate investment trust market fell a whopping 75% globally because these funds had created income which couldn't be sustained under high debts and falling prices. Some super funds stopped members from transferring money out because they were unable to sell illiquid, unlisted assets. One fund, MTAA Super, lost $1.6 billion due to poor hedging of unlisted assets. MTAA Super lost its spot as the best performing fund in 2008 and became the second worst on super ratings. Comparing apples with apples is important as well. With all the laws and consumer protections we have in place in Australia, it amazes me how we don't have a standardised format for A, the label of super funds, for example, growth, balanced and conservative. B, what assets constitute as defensive or growth assets. I believe that by having parameters around the above legislated, consumers can confidently compare their super choices on a transparent and level playing field to ensure that they are investing in a fund that suits their needs and risk appetite. Thanks very much for listening. I hope it's been useful. If you would like to discuss any of what I've said this afternoon in more detail, please don't hesitate to call 073343 9228 or email me at steve@ascentwm.com.au. Thanks very much. Have a great weekend, and we'll talk to you soon.